What is going on in the Sydney property market right now? ANZ has just forecast the biggest property crash in Australian history, a 15% decline in the average Sydney house price, and that forecast came just days after NAB also revised their outlook. Auction rates continue to trend lower, listings continue to trend higher, and at the same time, I've also had a number of investors reaching out asking me the same question. Is now maybe even a good time to get into the Sydney market? Hi, I'm Jono. I've been part of close to 1,000 purchases for investors over the last 5 years, and I bought 37 properties last month. On this channel, we talk about property and finance, and in this video, we will go through the latest ANZ forecast for the Sydney market, which areas are tipped to fall the hardest and which may hold up, and should anyone be buying in Sydney at all right now, or should we all be selling? So let's get straight into it. So what reasons are given by ANZ for their latest predictions? And we're going to look at the quotes from their lead economist, and they're basically tipping that the main reasons that are going to cause the price falls are interest rates being at their elevated levels, the budget's changes on investors' participation in the market, and the consumer sentiment. Let's go through each of these individually and we'll look at how they are influencing suburb by suburb different parts of the Sydney market. So interest rates are at their highest since COVID. We've had 3 hikes in 2006 already, in February, March and May, and the higher the rates always hit the top of the market the hardest. If we look here at the median house price in Sydney, we will see a lot of the areas have house prices above $2 million. And so when interest rates rise, this top end of the market is likely to be the most impacted because it's where people are stretching themselves the most. And it's where you'll see the biggest falls. And that's exactly what we do see. When we look at the 3-month growth, you can see broadly it's the same more expensive areas that are bearing the brunt of the price falls, with some areas falling between sort of 5 to 7% over the last 3 months. They're on track to fall even harder than 15% if that trend continues over the next year. But broadly, they are going to influence that 15%, that top end of the market the most. ANZ also have cited the budget changes and the negative impact it's had on investor participation in the market. So the budget changes removed the ability for investors to negatively gear their properties. And so it means that they get less money back when they do their tax return for the loss that they are making by holding a property. And so this in turn reduces their income, and therefore reducing their income reduces the amount that they can borrow, which in turn reduces the amount that they can actually buy. And so in the same way it applies to owner-occupiers, where affordability is now stretched, at the top end, you're going to see the least participation. It's two sides to the same influence for investors. They've had interest rates rise, which has reduced their borrowing power, and then they've had the budget changes, which has also reduced their borrowing powers. And this is exactly what we're seeing in the latest CBA data as well. So CBA have recently revealed their mortgage applications are down around 15 to 17% in May, and the majority of that was led by investors. They have cited around a 30% drop in new loan applications for investors and around a 10% drop in owner-occupiers. Westpac also recently revealed a similar decline with their quarter-on-quarter loan applications down around 11%, and post-budget their run rate was down about 20%. Now, the third reason given by ANZ was the consumer sentiment, which is by their own recording at the lowest levels it's been since COVID. You can see there that really only in COVID or the 2008 crisis did we get close to this, which is it's the lowest level in 50 years. The major contributors to this are the AI disruption on the horizon, cost of living, but the one that was quoted in this most recent report by ANZ was the war as well. All these factors are influencing people. People are generally quite scared at the moment based on this metric. When people are scared, they're not going to make big financial decisions. People are going to sit inside and watch out the window and wait for things to get better. Obviously, we speak to a lot of agents, and what we're hearing on the ground now, especially in these more expensive areas, is that people that are selling are ones that are motivated to sell. So they maybe have a reason, like there's been a death in the family and they've got to wind up an estate. Maybe there's been a divorce where the divorcing couple one of them can't hold on to the property. You know, maybe there's someone who's leaving to work in a different location and they can't afford to hold on to the property because of the one that they've got to afford when they move to the new location. Or maybe there's some debt that they need to repay, or maybe they just can't afford the mortgage with the interest rates that have risen. We are starting to see that a little bit in the latest CBA data, although it's nowhere near levels that would be overall concerning. And when sellers are motivated, they can't wait for a better offer. They have to take a price within a certain time frame, and this can pull the median price of areas down faster because a disproportionate amount of the properties that are being sold by those people who have to sell and are forced to sell and are going to take a lower price. And I came across a really good example of this the other day in Sydney in Castle Craig. So this property, it was bought for $5.3 million in 2023 and sold a couple months ago for $4.8 million. So they took a loss of around $500,000 just on the difference in the purchase price and the sale price. But they would also had to pay, stamp duty, agent commissions, which would have probably amounted to around sort of $350,000 to $400,000 as well. So overall, they would have lost between $800,000 to $900,000 on this purchase. But although there are a lot of negative influences on the market right now, the Sydney market is a big market, just like the Australian market is a big market. And just because the median house price is falling, it doesn't mean that every single dwelling in Sydney is falling. You can see here that some unit and townhouse markets are actually holding up okay and are even still growing slightly, even with the current turbulence in the broader Sydney market. You've got some places down near sort of Campsie and Lakemba where units are growing, and I know they have been quite strongly over the last 12 months as well. In these markets, it's extremely supply constrained, and if you're buying a townhouse or maybe a unit, let's say, for under 600,000, then there's really a floor on the price because of the cost it would take to replace a property like that. When you've got construction costs around sort of minimum 4,000 a square meter, and then land also very expensive depending on where exactly you're buying it. You're buying something, if you've got a little bit of land and a reasonable sized unit or townhouse, that is going to be way below the cost it would be to replace. That's exactly why in the same ANZ predictions, they're also saying that Sydney is predicted to come out of this because the construction costs have been pushed up further by the Iran war because of the influence of oil in supply chains on material. And you can see that we're actually further behind target for the number of homes that we need to build because of the Iran war. And from speaking to developers, I know that they don't want to develop into a falling market. They need at least a sort of stable market so they can be sure of the profit that they're going to make. And this is also what the RBA governor mentioned on Tuesday when she gave her comments around interest rates. She mentioned that she was very concerned with the structural undersupply and doesn't expect that the budget changes will have any meaningful impact for another 2 years. And that would be assuming that they go as they are predicted to go, which means that developers will participate and investors will buy into these new builds, and the supply of property is at the rate that they've been hoping. Well, we can see historically that they've been really poor at creating the supply required. So don't see why that's going to change now. And the final thing that we'll look at here is rents. So if we look at Sydney rents, they've been rising across the board over the last 12 months. And this is really going to be exacerbated by the budget changes because investors are only really going to buy at the bottom end of the market now because it's just going to cost them too much to hold more expensive properties without the benefit of negative gearing. So they're really going to compete only with the bottom end of the market where also the first home buyers have the 5% deposit scheme. So broadly, this part of the market is likely to hold up a little bit better. If you're buying above maybe let's say $1.2 million in Sydney, I would say wait because the market's likely to come to you over the next few months and you're also likely to find distressed sellers. If you're an investor, I would really only look at sort of units or townhouses where you get a reasonable amount of land component in supply constrained areas. But broadly, I would say Sydney is probably not the best city to be investing in right now. There's other areas that are, I would say, a lot better with the different metrics that we consider. Obviously, supply and affordability is a big part of it, but there's over 150 metrics that we use to analyze a suburb before we deem it worthy of investment. And there's much better areas that are performing much better and will perform much better over the short and medium term. If you are interested in buying an investment property, please feel free to reach out. I'll put my contact details in the description.